Bloomberg Audio Studios. Podcasts, radio, news.
Here's the word on Wall Street. Lisa Shalett of Morgan Stanley writing this. With equities having round-tripped back towards first quarter ending levels, markets are anxious to move on from tariffs and attempts to anticipate Fed policy. Lisa joins us now for more. Lisa, good morning.
Good morning.
How many times have we asked this question? Was it all just a bad dream? Can we just move on?
So, look, I think investors right now are weary and want to move on. They want to look through it. But I do think that things have fundamentally changed from the Nasdaq peak back on December 16th. I think the first thing that has changed is it's really clear that top-line growth among the Mag 7 is decelerating. And growth investors typically don't like to see deceleration. The second thing is we're seeing this arms war with regard to CapEx spending continuing. If we our latest update on looking at free cash flow yields shows Mag 7 free cash flow yields shrinking by about 11%. Typically, these stocks don't tend to do particularly well when their free cash flow yield is coming down. And look, we can pretend that the DeepSeek news doesn't mean anything, but we fundamentally think it was the wake-up call around global engineering, global innovation, and the fact that none of us know how the movie ends here on Gen AI, who the winners are going to be, how it's going to evolve, whether or not large language models very quickly become commoditized, and the next, phase of the build-out is actually much lower data center intensity, much lower energy intensity, because it's very application-based. So nobody knows nothing, and I think right now this is a market where we've had a lot of positioning, technical positioning, where people felt, hey, I was caught off guard. This was a massive surprise. The effective China tariff rate is much lower than I penciled. I got to plow back in. You've got, some of the private wealth money and retail money coming in from the sidelines. But I think we're going to stall out here. I think it's just hard to justify the numbers. You round-tripped back to January 1st. On market levels, and yet your earnings per share are down 6%.
So you'd fade this move?
I'm fading.
What would you rotate out of, and what would you rotate into?
Yeah, so, we're continuing to, recommend that folks take some profits in now the new leaders again in tech and really focus on the beneficiaries of deregulation. And so we see that as, financials, we see it as energy, we see it as, some of the healthcare names. I know for viewers out there that's going to sound like a big value style bias, but quite frankly it is. While we're not saying you've got to be overweight value, we do think you want value in this market because you want some risk premium. I mean, there are risks out there, and you want to get paid to be in this market.
What risks do you want a premium to be paid for? And this sounds sort of existential, but it goes to the heart of the question of, is it inflation, or is it recession, or is it both?
I think it's a little bit of both. I think we're somewhat less freaked out about inflation than perhaps we would have been if the tariff rates would have held. I think what we're worried about is that we're no longer in a forecastable policy backdrop, right? As much as we all want to hand-wring about the Fed, for the last 15 years, Fed policy has been reasonably stable and reasonably well telegraphed, and there haven't been massive surprises. I think when we shift to a fiscal policy backdrop with this administration, as we've seen, it's very easy to experience both negative and positive surprises on policy. And that's what I want to get paid for, is that at any point, things can take a U-turn based on the headlines.
How much do the rest of the universe that you didn't mention, big tech that you're selling on the margins, or some of the financials and other value stocks that you're looking at that aren't exactly value, as you pointed out, how much do you think that it really will require Fed cuts to get the rest of the universe involved in some sort of positive momentum?
I think the rate cuts are absolutely, required for small cap, mid cap. I think that universe has suffered profoundly, from the higher cost of capital. By and large, the S&P 500, which is predominantly large and mega cap companies, have been pretty isolated. They have very healthy balance sheets, and for the most part, they haven't been inhibited by rates where they are, which is why we have multiples where they are.
Well, it raises this question, especially as the fiscal debate heats up in Washington, D.C., and you alluded to this, and there's a question about, as we find out how much the deficit is going to increase, how much bond markets are going to freak out, to use your sophisticated parlance. But there is this question of at what level in a 30-year, in a 10-year yield, it becomes prohibitive for stocks to really move higher from here and really inject some damage.
Yeah, I mean, look, I think for most of the last, 6 to 12 months, that, 450 on the 10-year, 4.5% on the 10-year, was kind of this stall out threshold. The market seems to be battling with it a little bit this week. But look, I think if we back up, if we get big deficit numbers coming out of this tax bill, and that 10-year moves into that 475 range, I don't see how the market, how equity valuations hold here. The math just stops making sense.
Lisa, it's good to see you, as always. Thanks for dropping by. Lisa Shalett of Morgan Stanley.